Hello and welcome to today's Premium Account Market Update for March 2015. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, current Managing Director of Investor Signals, and have over 17 years of experience in the financial services industry as a licensed securities and derivatives advisor. The topics for today, we look at the macro update driving equity markets. We roll through the ASX top 50 stocks with a particular focus on FY15 earnings, PE valuations and current dividend yield. As I go through the top 50 stocks, I'll talk about our preferred portfolio allocations and conclude with a short-term Australian market outlook. The Investor Signal service is centred around a premium account broking model, where we run a model portfolio of ASX 50 stocks. We utilise call options to enhance portfolio returns. We're focused on effective ownership around ex-dividend, while still generating some capital growth above average cash flow, all under a strict investment mandate, and the assets remain in your name. If you'd like to know more about the service, please contact me, leon@investorsignals.com. Moving straight into a graph of the Dow Jones. Now, interesting at a global level, we've obviously seen US earnings for the December quarter conclude, and the general theme of the December quarter US earnings was that revenues were, whilst it was muted, there was some revenue growth which was pleasing. At the profit line, probably the only negative impact was the high US dollar. And the US dollar index continues to move higher, and I'll in a moment move on to a graph of the euro dollar just to see sort of where the flip side to that strong US dollar is being the lower euro. But obviously for international companies in the US that are growing or delivering sales from international markets, a strong US dollar works in reverse in that it reduces their earnings when they're converted back to US dollars. So we're seeing where S&P 500 earnings were likely to grow at around 8%, we're seeing that number somewhere around 4%, so it's hard. And that's predominantly not at the revenue line, it is at the profit line, and partially impacted by the US dollar. Obviously also slowdown in Europe, continued sort of below trend growth in China, and Japan. Interesting when you look around the world, inflation's running predominantly at about half the pace of what the target rate for central banks are. So, that on one hand you've got the bears in the market that focus on the deflationary picture, and their argument would be pointing to oil, iron ore, coal, all your commodity spectrum, which has clearly had large falls over the last 12 or 18 months. So a lot of those signs, combined with the fact that the inflation data is quite weak, a number of bears are focusing on that sort of deflationary outlook as the biggest concern for equity markets. And essentially, to continue that line of thinking would be to say that the quantitative easing of the central banks will eventually be a failing strategy. I'm not sure that I sit in that camp. I probably don't share that view. I think there are some risks that maybe Europe and Japan don't get the same benefits to their economy as what the US has had from the quantitative easing, but time will tell. And I think for that reason that we're unsure yet as to what the outcome for the Eurozone or Japan, and whether the People's Bank of China and the reduction in rates and the stimulus that they're starting to put into the Chinese economy, how that's going to offset the obvious overcapacity in the industrial and residential construction boom that China's enjoyed over the last decade or so, and in particular since the GFC, that's really driven Chinese growth. So you've got a couple of big macro global issues there that weigh on equity prices. And then I'll get to it in a moment. The real big thing that's taking place right at the moment, and speaking sort of on a very short-term basis, the 200-odd plus fall in the Dow on Friday night was really a result of stronger employment data in the US and the prospect that the Federal Reserve will have to move quicker to raise interest rates. Now, I think that's a buying opportunity for equities, and that'll be the focal point of today's recording as we go through the top 50 stocks. But from the S&P 500 up on screen there, you can see the move down last night. As I mentioned, the cause of that largely being better employment data and prospects of interest rates increasing probably around June in the US. I've always been of the view that probably resistance this year for the Dows may be somewhere up around 18,500 points. I still think equity markets have up to a 10% downside risk off the back of a macro event, whether that be interest rates increasing quicker and more than people expect, or alternatively US growth stumbling and concerns that quantitative easing in the Eurozone and Japan don't deliver the same result. So they're two opposite ends of the spectrum, but two real issues that the equity markets face over the next 6 months. So I'm probably more inclined to think that quantitative easing does deliver economic growth, albeit at a muted level. I do think equities are getting very expensive. Risks do sit, in the Dow back to around 16,000 points, but that's not, that's probably only a 10 or 20% chance. I think more than likely we may get a sell-off down to around 17,000 points thereabouts, which is probably something in the order of another 5 to 6% type thing. And I would think that would create some good buying opportunities in our local market. And we'll have a look at those particular names in a moment. All right, so to skip through the rest of the macro picture pretty quickly, let's have a quick look at the 10-year treasuries in the US. Now, over the course of the last year, I've been focusing on these, and I've spoken a lot about how the bond market doesn't share this view that interest rates are going to be rising anytime soon. And really, what I've been focusing on when making those comments is we can see the 10-year treasuries have actually been trending lower, which means this is the yield on the 10-year treasuries have been trending lower. And in fact, if you go back only sort of a few months back, it touched down at around 1.5%. Since then, we've seen the yields really start to increase, and we're trending back up to around that 2 to 2.5% range, currently trading about 2.2. You can see the jump there in Friday night, which again was off the back of that stronger employment picture. So what this is now starting to point to is the bond market's actually beginning to believe that interest rate rises are coming for the US. That has some implication for things like the euro dollar heading lower, the Aussie dollar heading lower, which maybe starts to impact the way you think about portfolio allocations in the top 50 stocks and companies that have offshore earnings. On that note, let's just have a quick look at the euro dollar, because I think this sort of spells out the flip side of the strong US dollar. Here we're seeing the European Central Bank announcing $1.1 trillion of quantitative easing, which is essentially their equivalent of bond buying and asset buying program that the US went through over the past, say, 5 years post-GFC. In that environment, the US dollar became very weak. Obviously, in Australia, we saw the benefit in a very high Aussie dollar, up at around 108 to the US dollar. Now that trend's starting to reverse. The US have finished their quantitative easing. Europe's beginning, Japan's beginning, and Australia's obviously having to drop interest rates. So the euro dollar's had a substantial fall from 138 against the US dollar down to 108. In all probability, it's probably likely to go down further. Now, the reason why I highlight this is because I mentioned the fact that the high US dollar is eroding S&P 500 earnings at the bottom line. I don't think that trend's likely to stop. Therefore, over the next 6 to 12 months, having interest rates potentially increasing in the US, an ongoing strengthening US dollar, one would think that the probability of the S&P 500 companies really growing earnings above trend is minimal, and therefore I think sort of any expectation of another sharp rally higher in equity markets is at the lower end of the scale. What will drive equities is if we suddenly see better economic data out of Europe, and we've seen the ECB come out and upgrade earnings growth expectations, or GDP growth, for the Eurozone. Now look, it's a little bit ahead of the outlook, I suppose, in that Mario Draghi from the ECB is already forecasting that the economy is going to enjoy the benefits of the quantitative easing program. Now that's a little bit unproven, but obviously if we do start to see better manufacturing data, better consumer confidence data, better GDP data out of the Eurozone, then I think that'll help to maybe underpin equities and drive them a little bit higher. Equally the fact with China. So there's a couple of external factors there that we have to keep an eye on in regards to whether the S&P 500 stocks can move higher. But I just want to bring your attention to the impact that these currencies are having on equity markets at present. Finally, let's have a quick look at the domestic market, what that means for us. Now, we've just finished the FY14 calendar year earnings, or first half FY15, depending on how the companies are reporting their results. But effectively, earnings up to December showed that the underlying trend for the XJO X resources is growing at around 7%. We know the resource names missed to the downside on the lower commodity prices. The strength's been in industrial names, banking, and REITs and property development type companies, and obviously in consumer and retail spending. But what that means for our market is we're sitting on a relatively high forward PE, sitting at somewhere between 16 to 17 times forward earnings. I think if you take into account the view on the US market, I think our market could probably pull back to around 5,600, find support, and there would still be some good buying opportunities, and we'll focus on those as we go through the top 50 stocks in the following reporting. Okay, so moving straight into them, AGK, we're buyers of this name at lower levels. We've enjoyed the rally up, we've collected the dividend, or we've taken profit. But certainly, this was one of the names that I've been pushing over the past 3 to 4 months, and we've enjoyed the benefit of this rally. The company delivered earnings expectations or earnings that slightly exceeded market expectations. The stock trades on about a 4.5% dividend yield, trades at about 15, 16 times earnings. From an earnings outlook standpoint, the company should grow earnings about 8 to 10%. I think it consolidates here and moves sideways. I think it's a good defensive name in portfolios. For new money coming into AGL, it really is a matter of buying it at these levels, going out 6 months, selling the covered call, collecting the upcoming dividend. I think the stock really trades sideways out on near this $15 price point. Asiano, not a bad result for Asiano, but still the theme here is there's not a lot in the way of revenue growth. They've been very disciplined on cost control. The stock trades on a little over a 3% dividend yield, trading about 16 times earnings. You can see where I've marked on screen there at around $6. I'm happy to take another look at it. I think it's just a little bit expensive here right at the moment. Amcor, the interesting theme with Amcor's earnings result was their developed markets business really didn't deliver much in the way of earnings growth compared to, say, that of the emerging market business. The company announced a $500 million share buyback. That's helped to rocket the share price higher. It is expensive. It trades about 3.5% dividend yield on 20 times earnings. The company will deliver about 6 to 7% earnings growth over the next 12 months. Is a beneficiary of a higher or stronger US dollar. We've been participating in Amcor really over the past few years. Other than this period of consolidation where for sort of 12 months it moved sideways and really spent the bulk of sort of this period at or near this $10 price range. Now it's broken out. I still think we're probably in a phase where it consolidates again, given this high PE multiple. And the earnings result was good, but it certainly never pushed into the double digits like maybe some people were hoping. The $500 million share buyback supports the price. So given that we're of the view that the US dollar is likely to remain strong, I'm attracted to reallocate capital again to Amcor, and again, like the story with AGK, go out 6 months or so, sell the covered call, collect the upcoming August dividend, allow a little bit of capital growth, but probably not looking for upside much above $15 in Amcor, and really becomes an income trade for portfolios as a way of driving returns out of the market without taking on board too much risk. AMP, not doing too much here, not a bad result in earnings, up about 10% on a forward outlook, looking for similar growth. Puts the stock on a dividend yield on a forward basis of about almost 5%. So worth keeping an eye on any pullback there with AMP. ANZ, out of all the banking stocks, ANZ just worries me a little as to whether we get a period where some bad loans from the Asian markets are announced. Now, we're not seeing any evidence of that. Obviously, the slowdown in the mining sector, arguably, we could see some provisioning for bad loans there. But given that we're probably only looking at around 3 to 5% underlying earnings growth in a good environment, I don't think it hurts to start, trimming some of the banking exposure and locking in some gains, and we've largely been doing that on portfolios. So at or near these levels, I think short-term ANZ looks reasonably full value. APA not doing there at present. ASX, so this was an interesting earnings result. Now, we've been owning ASX over the last few years, really, and selling the covered calls against it. And historically, you can see here, once the stock got up to around $39, it ran into resistance. So we've enjoyed sort of buying it down here at around 35, collecting the dividends, selling the covered calls, and it's been a great contributor to the income line of portfolios, whilst providing a reasonably defensive asset allocation, given that the underlying business is growing around 5%. There's some chance of corporate activity, maybe, whether it be Singapore or the Hong Kong Stock Exchange may sort of run the numbers on ASX, and we may see another takeover proposal there. But the underlying business is growing around 5%. The dividend yield of the stock's just over 4%. And then we've seen this real sharp breakout here off the back of the earnings result. Now, interesting, there was nothing in the earnings result that particularly outperformed market. The underlying growth of the company is tracking at around 5%. Earnings per share just over $2 on a forward basis. They're probably likely to deliver around $2.15, $2.20 of earnings per share. Into 2016, it puts the stock on about 15 times earnings and about a 4.5% dividend yield. The company did make comment about their aggressive reinvestment in technology. Look, in some ways that's a capital expenditure. I don't know whether that's what the market really has got excited about, or whether it is just increased speculation of a potential takeover. But we've seen the yield compress on ASX from around sort of 5.5% down to low 4%. And I think the earnings outlook is a little bit similar. The other point worth noting is trading volume did pick up in January and February, and maybe that's also adding to some of the excitement there around ASX. But we certainly owned it at lower levels there. We locked in some profit around $39, $40. We'll keep an eye on this. If there was an opportunity to buy back in at around $40, probably happy to take another look at it. It looks to be breaking out and moving higher. AZJ, again, a little like Asiano, not much in the way of top-line revenue growth. The market was looking for a little over double-digit earnings growth. It didn't come through. It delivered around 9% earnings growth. AZJ, I've got on a yield of around 4%. The company is in the middle of a share buyback, which underpins the downside. I'm a buyer at $4.50 and a seller up at around $5.20. So to the extent that the stock pushes back up to $5, happy to sell the $5.25 calls. Anywhere really from $4.75 down to $4.50, I think, is a buying opportunity. But given that there's limited revenue growth, lower commodity prices, I think there will be some pricing pressure on new contracts that are negotiated over the next 12 months. All things being equal, I think AZJ is likely to mostly trade sideways over the course of 2015. From a forward earnings outlook, I think with a bit of cost discipline, they can still deliver high single-digit earnings growth. BHP, so a big theme of the commodity names was obviously cutting their capital expenditure. Strong dividend yield of around 4.5 to 5% yield. I've just highlighted from a technical base here that we're seeing this structural lower low and lower high. So I've really just flagged that as something for us to keep an eye on. Be interesting to see if we get a little bit of a sell-off and a rally back and see what type of pattern begins to form there. But still, I think, BHP, Woodside Petroleum, Rio, there's still an argument that there's a place in portfolios for those names. We're staying exposed to BHP ahead of the upcoming spin-off of South 32. Brambles, good earnings result here, earnings up about 8%. On a forward outlook, continue to deliver somewhere around 6 to 8% earnings growth. A lot of US dollar earnings here in Brambles, so beneficiary of a lower Aussie dollar when they're reporting their earnings result. At these levels, though, let's put some numbers on the valuation of the stock. On current 2015 numbers, it trades almost 21 times earnings on a 3% dividend yield. Now that's getting expensive. Even allowing for some earnings growth in the order of 8% into next year, the stock's still on a 3.5% dividend yield and almost 19 times earnings. So there's a rush into this at the moment. I think it's predominantly being driven by the US interest rate yields ticking up, US dollar being strong, at around 11.50, 11.80. I think it runs into some pretty significant resistance, if not sooner than that. And I would be looking for a correction in Brambles, and we're happy to take a look at it at the bottom of that sort of sell-off. They're getting very expensive up here. CBA, I think the range for CBA, I don't think there's much risk to the downside here, but certainly at around $85, $86 with buyers of the stock, $95, I think you want to be selling covered calls. So if we do get this sell-off in the Dow like we're expecting, and maybe Friday night was the beginning of it, I'm not expecting it to go much more than maybe another 4% or something in that order. So for CBA, that would bring it back to around that level of around $86, and we're happy to take another look at it at or near that price point. Coca-Cola, so interesting, the commentary out of the company during earnings season is that the downgrades are largely behind them. Now that doesn't mean that we're suddenly returning a strong double-digit earnings growth. I think a good outcome for Coca-Cola over the course of the next 12 months is if the earnings can stabilise and they'll deliver around 5% earnings. So that should translate into around a 45-cent dividend for Coca-Cola in the 12 months ahead. That puts the stock on about a 4.5% dividend yield and about 18 times earnings. So still expensive. I think the stock runs into resistance at $11. Shouldn't trade any higher than that, and the range is really $9.50 to $11 over the course of the next 12 months. And we need to see evidence that obviously the earnings downgrades have stopped, and we are going to sort of see a return to maybe 5 to 10% earnings growth that the market's looking for, and that's certainly priced into the stock at present. Computershare, another one that's getting a little expensive, trading at a 3% dividend yield, about 16 times earnings. Interesting though, we've seen the earnings growth being downgraded from 10% to 5% to a pretty muted sort of outlook, so maybe 0 to 5% earnings growth over the next 12 months. The company did make comment about them being fairly aggressive on looking for new acquisition opportunities. That's really what's helped to push the price higher, along with, again, the fact that a lot of their earnings are in US dollars, and we're seeing the strengthening US dollar there. But that's pushing these valuations up to levels that are getting a little bit hard to justify. CSL, same sort of thing. A lot of US dollar earnings and money's flowing into this name. We've seen the company continue with they're about a third of the way through their last round of $900 million share buyback. The company delivered about 8% underlying earnings growth, which is a little bit short of where the market was looking for, maybe 10 to 12% earnings growth. And this was the miss in the earnings result here, but the stock's recovered quite quickly following that. From a numbers standpoint, trades 23 times earnings, less than a 2% dividend yield. Some analysts have price targets of around 105, 107. I'm probably inclined to think that the underlying business is not going to do much better, but this strong US dollar theme probably continues to ensure that the stock's well supported on any sell-off. Crown Casino, we're seeing their domestic business deliver fairly stable earnings. Macau continues to deteriorate. We've seen the Barangaroo project with Lendlease in Sydney there push through New South Wales Council or state approval. At $15.50 though, Crown trades on about just under a 3% dividend yield, about 19 times earnings. On a forward outlook, if they continue to deliver around 10% earnings growth, it supports this $15.50 price point. It's certainly one that we've owned at lower levels. In some portfolios we're still sitting on it, but I think at around $15.50 it sort of tracks sideways. Fortescue, not doing anything here at the moment. You've probably seen in the media that the company's been working hard to renegotiate their debt obligations and effectively refinance costlier debt with cheaper debt and taking advantage of lower interest rates. At an earnings level, the company really didn't do much to excite the market. In fact, the earnings came in well below expectations. We've seen the dividends trimmed from 10 cents a share down to 3 cents a share. And it's really a name that we're avoiding, so we're not sort of seeing Fortescue really as a turnaround opportunity at this stage. Goodman Group delivered great earnings results, underlying business growth of around 8%. I think that continues to support Goodman Group, but again, looking at it on a yield basis, about 3.5% dividend yield, starting to get pretty expensive there. But Goodman Group and GPT have been our preferred sort of property plays. GPT delivers around 4.5% dividend yield. Earnings growth came in a little bit below expectation on a forward outlook, looking for about 4%. But happy to be a buyer of GPT on any pullback, and whether we sort of see that opportunity over the next week or not, or so, we'll have to wait and see. But certainly the prospect of it trading above $5 over the next 6 months would seem fairly limited, and I think it's a case of owning the stock and selling the covered call. IAG delivered an okay earnings result, albeit the insurance margins for IAG and Suncorp, there is some downward pressure on them. IAG trades at about 5.5% dividend yield. On a forward outlook, I think the earnings growth is maybe somewhere around 5%. So a push back up to anywhere around 6.25. We look to sell the 6.50 covered call. IPL delivered a great earnings result and continue to probably surprise to the upside, around 15% earnings growth over the next 12 months. Puts the stock on about a 4% dividend yield into 2016. Has got maybe a little bit ahead of itself here. I see fair value probably somewhere back at around 350 to 375 for IPL. James Hardie delivered earnings results that exceeded market expectation, about 20% underlying earnings growth there, beneficiary obviously the ongoing recovery in the US housing market. On a forward basis, the company should deliver about 10 to 15% earnings growth, which supports about a 4.5% dividend yield into 2016. Lendlease delivered in excess of 10% earnings growth, and on a forward basis should continue to do the same. Puts the stock on about a 4% dividend yield into 2016. Any opportunity to pick this name up on any weakness in the market, so back to somewhere between $15.50 and $16, we'd be keen to take a look at Lendlease. Mirvac Group was a beneficiary of strong residential construction market here in Australia. From a valuation point, the stock trades about 18 times earnings, just over a 4% dividend yield. Again, all these property names, if we see a little bit of a pullback on market weakness, we're happy to jump in and reallocate capital to those. Macquarie delivered earnings results that exceeded market expectations. On a valuation basis, the stock trades about a 4% dividend yield and about 16 times earnings. The market is pricing in another round of 10 to 20% earnings growth into 2016 for Macquarie. So all the banking stocks, essentially the same, ongoing earnings growth of somewhere around 3 to 5%. I think they've enjoyed a good rally. They're up, well over 10% over the past three months or so. I think they're running into resistance at or near this level, but it sort of fits in with our view that the S&P 500 struggles to go too much higher short term. Newcrest, the earnings result indicated that they had reasonable free cash flow. The earnings result missed a little bit on the downside. Production was upgraded to around 2.5 million ounces. I think that sort of bodes well for Newcrest, albeit clearly the problem is if the US dollar continues to move higher, the attractiveness of gold diminishes, and I think we're in that environment at the moment. So I think Newcrest could easily be under weakness over the course of the next week or two, whilst we go through this period of speculation around US interest rates moving higher sooner than later. Origin, at these levels, I'm happy to be looking at Origin on a tight buy-right strategy. I really think the earnings growth doesn't come through for another 12 to 18 months. I've got the stock at around 20 times earnings on a 4% dividend yield. There'll be as revenues start to increase from their LNG sales, there'll be a real focus on ensuring the balance sheet is supported. So the prospect of increased dividend yields or capital return to shareholders from the new revenue streams, I think, is pretty limited. But at around sort of this $12.50 to $13.50 is the range for Origin, and happy to be a buyer of it with selling covered calls. Oil Search not doing too much here at the moment, but to the extent that we have been owners of it, we're selling the $8.50 covered calls. Oil Searchers, we've seen them increase their dividend payout ratio slightly, and on a forward basis we're likely to see that dividend tick up to somewhere in the order of maybe sort of 22 to 24 cents, which will put the stock on about a 3% forward dividend yield. QBE, so we've seen the company come out, they've raised $850 million to support the balance sheet, beneficiary of rising US interest rates. Insurance margins improved a little bit from sort of 7% up towards 10%. Hopefully we've seen the worst for QBE, and the stock continues to move higher. Right at the moment, my thinking is that yes, there is an opportunity for the stock to trade maybe up towards around $15, especially short term off the back of, again, the stronger US dollar and rate rise speculation in the US. But ultimately, when we get a pullback, it will be sort of the first higher-low structure that we've had for some while in QBE. Ramsay Health Care continues to deliver earnings growth in excess of 10%. The stock trades on about 30 times forward earnings and on less than a 2% dividend yield. So whilst the story is great, a lot of the success is priced in. Rio at the moment, trading on around a 5% dividend yield. Obviously the company's announced a share buyback program over the coming years. They're really working hard on stripping out their capital expenditure and driving down their cost per tonne of iron ore, and at $50 a tonne, and driving their cost base down to possibly as low as $20 a tonne. There's still reasonable margins in it for Rio and BHP. So Rio actually starts to look interesting, I think, at or near these levels. So our preference is still BHP, but probably starting to balance that out a bit more now, and looking at Rio as an alternative, or at least an equal weighting to that of BHP. Scentre Group not doing there at present. Stockland's a bit of a standout result from the Australian earnings season here. The company delivered around 8% underlying earnings growth. Their residential construction market and community construction business delivered good earnings. Up at these levels, the stock trades at around 5% dividend yield, around 18 times earnings. As with all the property names, we're interested in these names and we want to stay allocated to them. If we get an opportunity to pick them up on a little bit of a pullback, we'll certainly take a look at Stocklands again. Sonic Healthcare, expensive. We're seeing the earnings growth of the company only come in at around 2%. They do have a lot of US dollar earners, so another one of these names that are benefiting from that theme. But at around 19 times earnings and a 3.5% dividend yield, the stock's pretty expensive. We own it at lower levels, and we're just starting to take some profit. Santos, not there at present. Suncorp, our strategy here where we own it, we've been pretty aggressive with selling the covered calls. We collected the recent dividend. We collected an extra sort of 30 or 40 cents for those covered calls, and we're really looking for Suncorp to bounce sideways over the next 6 months. Sydney Airport, strong performance here by Sydney. The stock trades on a forward yield of about 5% and continues to deliver fairly defensive earnings growth. As does Transurban, we're looking for the dividend yield there for the dividend payout to increase to around 40 cents over the next 12 months. That will put the stock on a dividend yield of around 4.5%. And I think sort of in the environment where interest rates are low, Transurban is likely to sort of maintain these type of price levels. Telstra, so interesting that we're just seeing underperformance here in Telstra, and we've seen this often when the stock goes ex-dividend. We see some underperformance, and then it starts to rebuild momentum coming in to the next round of dividend, which will be August. So any opportunity to buy back into Telstra on a pullback to around $6 would be aggressively looking at adding that to portfolio allocations. Toll, we've been buyers of this at lower levels. We've sold out at or near the $6 level, and unfortunately we've seen the takeover come through from Japan Post. This wasn't something that I heard speculated in the market, and it really sort of came from left field. But in saying that, we have sold calls a number of times over the last few years, so we're effectively sort of getting the benefit of an exit price in Toll, probably closer to around $7. So we're still given some upside, but get some peace of mind of knowing that we delivered sort of reasonable income from the covered calls throughout this period, which needs to be added to the eventual sale price there, which gets us up to a sale price of around $7 there in Toll. Westpac Banking, as with ANZ and NAB, my comments are not too dissimilar to Westpac. It's had a good rally. I think there's an opportunity to lock in some profit at the moment. Wesfarmers, we're seeing this negatively impacted probably more from the Woolworths result than its own earnings result. So Coles delivered about 8 to 10% earnings growth between Coles and Wesfarmers. As a conglomerate, the business reported earnings growth of around 9%. On a dividend yield at the moment of around 5%, I think Wesfarmers still represents reasonable value. The issue here is that investors are a bit concerned about the potential price war building between them and Woolworths, and on that basis, can Coles continue to deliver its 10% earnings growth like it has been? I think in some ways that's been a recurring concern of the market, and Wesfarmers has continued to prove them wrong. But the flip side of that is there's probably not a lot to drive Wesfarmers too much higher from where it is at the moment. So any opportunity to pick the stock up on any weakness, we're aggressive buyers of it. As it rallies back to around $44, $45, we sell the covered calls, and we're driving 10% cash flow out of Wesfarmers moving sideways. Westfield, with the strong US dollar, we may not see this pull back too much, but any opportunity to jump back into Westfield at around the sort of $9.50 to $9 range, I think it's a buying opportunity. We let it rally, then sell it with covered calls. Now the prospect of it moving substantially higher is limited, and I'll just give you some numbers on this. The stock's now trading on a dividend yield of, on a forward basis, the company has confirmed that they'll pay close to 40 cents of dividends. So therefore at $10 a share, that puts it on a 4% yield. I think $10 is the range, and it really moves sideways for 12 months. So I do think it's a matter of buying the stock and selling the covered call in order to drive a reasonable return out of it. Woolworths, so we've seen their forward guidance downgraded a little. It was only marginal, but maybe the market's expecting sort of 2 to 4% earnings growth at best. That puts the stock on a dividend yield of around 4.9%. Woolworths doesn't pay their dividend until I think around the 18th of March, thereabouts. So I'd expect the stock price to strengthen a little into that dividend. And for new capital, we're just starting to pick up some Woolworths at or near these levels at present. Woodside Petroleum, on a forward basis, we'll see the company reduce their dividend payout ratio, and I think sort of the stocks on a forward basis probably yielding much closer to around 4%. So I think with oil at $50 a barrel, we're obviously seeing good production numbers out of Pluto. The company should deliver a dividend of maybe around $2 maximum into 2016, which will start to sort of pull that dividend yield back a little, maybe closer to around sort of high 4s, 5% dividend yield. I'm still interested in owning Woodside at these levels. And then finally, to conclude with a short-term look at the XJO, as the US market bumps up against resistance off the back of the higher US dollar and prospect of raising interest rates, I think our market struggles a little. I think at 5,700 we want to be a buyer, so any sort of sell-off that's somewhere around 3 to 5% in the names that I highlighted as we went through today's recording, we'll be aggressively stepping back into those names, riding some level of recovery back up, then selling the call options, picking up the August dividend, picking up the extra cash flow from the option premium. So giving ourselves some capital growth over the next, say, 10 months, ensuring we get the August dividend, getting the extra cash flow from the call option, all on the basis that we think the market's looking reasonably expensive. We do think there's some defensive positions to allocate capital to, so we don't see a great risk to the downside in those names, and if we can generate 10% return as a result of the dividend and the cash flow in a sideways or slightly down market, but still give ourselves exposure to some capital growth if the market, if Europe does deliver better earnings result, if China does start to stabilise and we do see equity prices move higher, then we're still participating in the capital growth. But most importantly, we're making money if the market moves sideways, and we're reasonably defensive if the market actually moves down and sort of bounces along the lower segment there of the trading range that I've highlighted on screen. Thank you for listening in. I look forward to speaking again soon. And if you'd like to know more about the Investor Signals Model Portfolio Service, please call the details on the screen.